NASDAQ selling off another 2%. Now people are asking if the AI bubble is popping. Here with his top picks and
the rise of AI-related stocks to the dot-com bubble of the 90s. My next guest, though, says the commercialization of AI is moving even faster.
If you look at valuations today, back in the late 90s, they're two different things. The other thing that you're looking at is the commercialization.
Character.ai. This is a 16-month-old startup with no revenue. It just raised $150 million from Andreessen Horowitz at $1 billion valuation.
And it's all about AI. We begin with nearly half of TEC members in our survey saying that artificial intelligence, that will be the top spending area for their company over the next 12 months.
Headlines everywhere are talking about an AI bubble. Investors are pouring billions into AI stocks. Tech giants are racing to build the future, and companies claim AI will change everything. But haven't we seen this kind of hype before? Are we about to see history repeat itself? Let's break it down. The term AI bubble refers to the idea that artificial intelligence stocks and companies may be overhyped, overvalued, and driven more by speculation than by actual long-term business fundamentals. AI has captured the imagination of investors, businesses, and the general public due to its transformative potential. The AI hype started gaining momentum in recent years, with breakthroughs in machine learning, large language models, and generative AI. Companies like OpenAI, Google, Microsoft, and NVIDIA have been at the forefront, pouring billions into AI research and infrastructure. AI has already changed our world in ways we never imagined. In healthcare, AI can analyze X-rays and MRIs faster than doctors, helping detect diseases earlier and saving lives. In finance, AI-powered fraud detection stops suspicious transactions before they happen, keeping your money safe. In transportation, self-driving technology is getting smarter, inching closer to a future where you can sit back and let your car do the work. But let's be real, where most of us actually feel AI in our daily lives is through chatbots and creative tools. Think about it. You need to draft an email? ChatGPT has your back. You want a cool AI-generated image for your Instagram post? DALL-E or Midjourney can make it happen in seconds. Video editing used to take hours, but now AI tools automatically remove backgrounds, enhance footage, and even create full-on deepfake videos. In 2024, companies worldwide poured unprecedented amounts of money into artificial intelligence, betting big on the future of this transformative technology. In 2024, venture capital firms poured $131.5 billion into AI startups, 52% more than they did the year before. Meanwhile, funding for other types of startups actually dropped by 10%, meaning AI is getting way more attention and money than anything else right now. Some AI companies pulled in massive amounts of money in 2024, making headlines with their record-breaking funding rounds. For example, Databricks, a company that helps businesses analyze huge amounts of data with AI, raised a whopping $10 billion at a $62 billion valuation. OpenAI, the company behind ChatGPT and other advanced AI models, secured billions in funding from Microsoft to keep pushing the limits of artificial intelligence. Meanwhile, Waymo, Google's self-driving car division, also attracted major investment as it continues developing AI-powered autonomous vehicles for the future of transportation. And the spending isn't slowing down. In 2025, major tech companies like Meta, Amazon, Alphabet, and Microsoft plan to spend up to $320 billion on AI and data center development, a huge jump from $230 billion in 2024. But here's the thing. Not every company splashing AI across its branding is actually revolutionizing the world. Whether it's on earnings calls or in advertising, companies are eager to add a little AI sparkle to their messaging. In fact, a record 199 S&P 500 companies dropped the AI term during their Q1 2024 earnings calls, the highest number ever, surpassing even the blockchain hype from previous years. It's no surprise that the stock prices of AI-related companies skyrocketed as investors bet big on the technology's future. The increasing demand for AI technology played a crucial role in NVIDIA's rise. NVIDIA rose in popularity over the last 2 years, largely due to the AI boom. Its chips became essential for AI systems, driving massive revenue growth. The company's dominance in GPU production for AI applications helped it reach new heights, even surpassing other tech giants at one point to become the most valuable company in the world. But NVIDIA isn't the only one riding the AI wave. Companies like Palantir, Microsoft, Meta, and ServiceNow, among others, have also seen their stock prices soar as they integrate AI into their products and services. However, history has shown us that extreme enthusiasm around a new technology often leads to an investment bubble. So, is AI really in a bubble, or is it different this time? Back in the late 90s, the internet was the next big thing, and everyone wanted a piece of it. Companies started adding .com to their names, hoping to ride the wave of excitement. It didn't even matter if they actually had anything to do with the internet. Just having that name made their stock prices shoot up. Investors were throwing money at anything that sounded tech-related, believing they were part of a gold rush. At some point, the U.S. Securities and Exchange Commission stepped in and warned people to be careful. They told investors not to get carried away by fancy names and big promises because, at the end of the day, a name change doesn't make a company valuable. And they were right. When reality hit, many of these .com businesses collapsed, and people who had invested without thinking lost a lot of money. Now, fast forward to today, and history seems to be repeating itself. This time, the magic word isn't .com, it's AI. Companies are throwing around the term artificial intelligence in press releases, earnings calls, and investor meetings, even when their actual use of AI is questionable. It's the same game all over again. Build excitement, raise stock prices, and hope nobody asks too many questions. But just like before, hype can't keep businesses afloat forever. When the dust settles, the companies that really know what they're doing will survive, and the ones that were just riding the trend will disappear. The question is, are people paying attention, or are they about to fall for the same trap all over again? To understand where this could be heading, we need to know what actually caused the .com bubble to burst, and more importantly, whether we are making the same mistakes all over again. First, overvaluation and speculation. In the late 1990s, investors became overly optimistic about the internet's ability to revolutionize business and daily life, believing that any company tied to the web would be wildly successful. As a result, startups with little more than an idea, or sometimes just a catchy domain name, were able to raise millions in funding. Many even went public with billion-dollar valuations despite having little to no revenue. Instead of looking at actual profits, investors focused on future potential and ignored traditional financial metrics like price-to-earnings ratios. This blind optimism sent the Nasdaq soaring from around 1,000 in 1995 to over 5,000 in early 2000, as everyone scrambled to invest in anything with .com in its name. Second, lack of profits. Many .com companies had no viable revenue model or were operating at a massive loss. Instead of focusing on sustainable business operations, they prioritized customer acquisition, marketing, and branding, aiming to grow their user base rather than generate profits. For example, Pets.com raised $82.5 million in an IPO in early 2000, but had negative gross margins and collapsed within a year. Third, easy access to capital. Venture capital firms and retail investors were pouring money into internet startups without due diligence. Many .com firms rushed to go public, often within a few years of being founded, to capitalize on the hype. With low interest rates and loose lending standards, banks and investors were eager to fund speculative businesses. Startups burned through cash quickly without sustainable revenue streams, making them vulnerable when capital dried up. Fourth, high burn rates. Many .com firms spent recklessly on lavish offices, expensive ads, and unnecessary expansion. For instance, Webvan, an online grocery delivery company, expanded aggressively without building a proper logistical foundation and burned through $1 billion before shutting down. Without consistent revenue or access to new funding, these companies simply ran out of cash and collapsed. By late 2000, reality caught up. Most internet companies were losing money, and there was no clear timeline for profitability. Investors panicked and began selling off tech stocks, causing a domino effect in the market. From March 2000 to October 2002, the Nasdaq dropped nearly 78%, wiping out trillions in market value. Even solid companies like Amazon saw their stock prices crash from $107 to $6 per share. But while there are similarities, the AI hype is different in some key ways, making it unlikely that we'll see a crash as severe as what happened in the early 2000s. Unlike many dot-com startups that had no clear path to making money, AI companies today are already generating real revenue. Businesses actively pay for AI-powered services, from cloud computing to chatbot integrations and data analytics. Secondly, during the dot-com era, startups were mostly on their own. Once funding dried up, they collapsed. But today, AI isn't just being built by startups. It's being driven by the biggest tech companies in the world. Amazon, Microsoft, Google, Meta, and Nvidia are pouring billions into AI because they see it as the next frontier. And even if some AI startups fail, these tech giants will absorb their technology and talent, preventing a total collapse of the industry. Microsoft's $13 billion investment in OpenAI, for example, ensures its survival even if market conditions change. Another key difference is AI is already here, and it's working. In the late 90s, many dot-com ideas were ahead of their time. Business models like Webvan failed back then, but today, similar companies thrive. AI isn't just something for the future. It's already making a big difference today. It helps businesses get work done faster, helps doctors find diseases earlier, keeps our data safe from hackers, and even makes movies and music better. So, if AI is so powerful and already making a real impact, what could actually cause a major crash? First of all, if AI-driven businesses fail to generate profits fast enough, stock prices could fall dramatically even if the companies themselves remain operational. Also, AI requires massive computing power, energy, and infrastructure, all of which cost a fortune. Companies like Microsoft, Google, and Meta are spending billions on AI data centers and NVIDIA chips, but they will eventually need to prove that this investment leads to real profits. If these companies can't show a clear return on investment within the next few years, they may pull back spending, slowing AI growth and hurting AI-focused stocks. And finally, right now, demand for AI chips is through the roof because companies are still in the building phase of AI infrastructure. But once these AI models and data centers are built, will companies keep buying chips at the same pace? If AI hardware sales slow down, companies like NVIDIA could see a major correction. So, AI is real, and it's already changing the world, but not every company that calls itself AI-powered will survive. If the hype gets ahead of reality and profits take too long to materialize, we could see a correction. It might not be a dot-com style meltdown, but some overhyped companies will fall hard. The question isn't whether AI is here to stay. The real question is which companies will make it out on top, and which ones will disappear when the hype fades. If you found this video helpful, hit the like button, share it with others, and don't forget to subscribe for more easy-to-understand and informative videos on investing. See you in the next one.